While most people were distracted by inflation headlines, election noise, and daily stock volatility, something far more structural shifted in the background of the financial system. Several major banks and bullion intermediaries quietly delayed or suspended physical silver deliveries over a weekend window. No press conference, no emergency headline, just a change in terms, extended settlement windows, and temporary unavailability notices buried in client communications. In one sentence, the core event is this: the paper silver market is colliding with physical supply constraints, and the delivery layer is starting to crack. That sounds abstract, and that's exactly why most people miss it. The crowd watches price ticks, $22, $24, $26 per ounce, and assumes the market is continuous and liquid. But silver is not just a number on a screen. It is a mined, refined, transported industrial input. Roughly 55–60% of annual silver demand now comes from industrial use: solar panels, electronics, medical devices, while the rest is split between jewelry, silverware, and investment demand. Global mine supply runs in the range of 800–850 million ounces per year. Total demand in recent years has been estimated closer to 1.1 billion ounces. That gap is filled by recycling and inventory drawdowns. Here's where the mechanism starts to matter. The global silver price is primarily set in futures markets, most importantly COMEX in New York and the LBMA system in London. These are paper markets. For every ounce of registered deliverable silver, there may be 100 to 300 ounces of paper claims layered on top through futures, swaps, and unallocated accounts. This structure works only as long as most participants settle in cash and do not ask for metal. What changed is not that silver ran out. It's that the ratio between claims and deliverable inventory became uncomfortable during a period of rising industrial demand and geopolitical supply risk. Banks that act as intermediaries, selling allocated or deliverable silver products, suddenly face a timing problem. If too many clients request bars at once and refining and transport lead times are 4 to 8 weeks, the bank has two options: source metal at a premium or slow the pipeline. This is the forcing mechanism. Inventory stress meets just-in-time financial plumbing. The crowd misses this because the price still prints normally. Futures still trade, ETFs still update, but the delivery layer, the physical settlement step that anchors the system to reality, begins to stretch. Weekend maintenance windows become longer. Delivery terms become conditional. Minimum bar sizes rise from 100 ounces to 1,000 ounces. Premiums detach from spot. Now, here's where it breaks. When financial institutions quietly ration physical supply, they are signaling that the system is optimizing for orderly function, not for immediate fulfillment. That's rational. It's also revealing. It means the paper market has outgrown the metal beneath it. What's at stake is not just silver pricing, it's credibility. Silver is a benchmark commodity used in electronics pricing, solar manufacturing contracts, and long-term supply agreements. If delivery reliability weakens, the price mechanism itself becomes less trusted. That ripples outward into hedging costs, into manufacturer margins, into inflation pass-through. This is not a collapse story. It's a plumbing story. And plumbing is what determines whether a financial system flows or backs up. To understand why a temporary suspension of physical silver deliveries matters, you have to separate price discovery from settlement reality. In modern commodity markets, these two functions are only loosely coupled. Silver pricing is dominated by futures contracts. A standard COMEX silver contract represents 5,000 ounces. Traders buy and sell these contracts for exposure, hedging, or speculation. On an average day, 100,000, 150,000 contracts may trade, representing 500 million to 750 million ounces of paper silver changing hands in 24 hours. That's close to an entire year of global mine production trading in a single session. But almost none of those contracts end in physical delivery. Historically, fewer than 1 to 3% of open contracts go to settlement. The rest are rolled, closed, or cash settled. That's not a flaw, it's the design. Futures markets exist to transfer price risk, not to move metal. The physical layer sits underneath. COMEX maintains registered inventories, bars that meet exchange specifications and are available for delivery. In recent years, registered silver has ranged from roughly 25 million to 40 million ounces. Against open interest that often represents 700, 900 million ounces of claims, the leverage ratio routinely exceeds 20.1 and sometimes approaches 100.1, depending on how you measure deliverable stock. This works because behavior is predictable. Most participants never intend to take metal. ETFs roll, funds roll, banks hedge and net. Only a thin slice of actors, industrial users, mints, a few funds, ever demand bars. Now introduce a disturbance. Suppose industrial demand rises by 5 to 8% year over year, roughly 60 million additional ounces, driven by solar manufacturing and electrification. At the same time, mine output grows only 1 to 2% because new projects take 7 to 10 years to permit and build. The deficit is bridged by inventory drawdowns. That's manageable until timing matters. Refining silver into 1,000-ounce good delivery bars takes weeks. Transporting them across borders takes more time. Banks offering physical delivery products promise clients a conversion from paper to metal, often within 2 to 5 business days under normal conditions. But those promises are not backed by a warehouse of idle bars. They are backed by flow. The bank assumes it can source metal from wholesalers, refiners, or exchange inventories on demand. Here's a concrete example. A bank sells 10,000 ounces of allocated silver to retail and institutional clients. At $24 per ounce, that's a $240,000 exposure. The bank may hedge this with futures, but it does not necessarily hold 10,000 ounces in a vault. Instead, it relies on the ability to convert futures into bars if needed. Now imagine that 20% of those clients request delivery in the same week, 2,000 ounces. Multiply that behavior across dozens of institutions. Suddenly, instead of 1 to 3% of claims converting, you have 5 to 10%. At COMEX scale, that's not a rounding error. If even 5% of an 800 million ounce open interest tried to stand for delivery, that's 40 million ounces, more than the entire registered inventory. The system's defense is procedural friction. Delivery windows widen. Minimum order sizes increase. Temporary unavailability appears. These are not failures, they are pressure valves. They slow conversion from paper to metal so the flow system can rebalance. This is the part most people miss. A delay is not a shortage, but it is a signal. It means the market is no longer operating with slack. The margin between claims and capacity is narrowing, and once that margin thins, price stops being just a number. It becomes a rationing tool. When a delivery system tightens, the impact is never evenly distributed. Some participants can wait, others cannot. The entire dynamic of stress in a commodity market is defined by who has flexibility and who does not. In silver, the most constrained actors are not speculators. They are industrial users. A solar panel manufacturer cannot roll its silver requirement. Each gigawatt of photovoltaic capacity requires roughly 700,000 ounces of silver in conductive paste. A mid-sized panel producer might consume 2 to 5 million ounces per year. If shipments are delayed, production lines stop. A one-week interruption can cascade into missed contracts, penalty clauses, and lost market share. These firms hedge price risk in futures markets. They lock in costs months in advance. But futures contracts do not deliver paste-ready silver. They deliver bars. The industrial buyer still has to source physical metal through banks and wholesalers. That creates a binary choice. Either the physical market continues to clear on schedule, or industrial users must pay up through higher premiums, longer contracts, or alternative suppliers. On the other side are banks and bullion dealers. They operate under capital and reputation constraints. A bank that advertises physical delivery in 3 to 5 days and then fails repeatedly faces 2 risks: regulatory scrutiny and client flight. But sourcing metal at any price is also dangerous. If spot silver is $24 and wholesale bars suddenly cost $27 due to scarcity, absorbing that $3 premium across millions of ounces becomes a balance sheet event. So the bank faces its own binary: either slow deliveries and manage flow, or chase metal and crystallize losses. Funds and leveraged traders sit in between. Some hold futures with the option to take delivery as a strategic threat. Others are short. A short seller who cannot roll a contract and is forced into physical settlement faces open-ended cost. If the nearby contract trades at a premium, say $1.50 above deferred months, that's backwardation. It's the market screaming, "Metal now is worth more than promises later." Backwardation forces behavior. Shorts must either buy back at higher prices or source metal. Market makers widen spreads. Liquidity thins. Volatility rises. This is structurally similar to what occurred in the nickel market in March 2022. A concentrated short position collided with physical scarcity. Prices doubled in days. The exchange halted trading, not because nickel ran out, but because settlement risk overwhelmed clearing systems. Silver is different in scale and participants, but the logic is identical. A heavily paperized market meets a real-world bottleneck. Households, by contrast, are the least constrained. A retail buyer can wait 6 weeks for coins. A mint can raise premiums from $4 to $7 over spot. Demand may slow, but it does not break the system. Industrial users cannot wait. Banks cannot default. Shorts cannot settle in good intentions. So stress concentrates where time matters. The historical parallel is the London gold market in March 2020. Pandemic logistics froze air freight. Gold bars in London could not reach New York. Futures in New York traded $50, $70 per ounce above spot in London. The metal existed. The price dislocated because delivery paths failed. Exchanges had to change contract specifications to accept different bar sizes. The lesson is not that commodities disappear. It is that market structure is only as strong as its weakest logistical link. In silver, those links are refining capacity, transport, and the thin layer of registered inventory that anchors trillions of dollars in notional claims. When that layer tightens, behavior changes first. Price follows later. To see why delivery stress emerges even when there is plenty of silver in the world, you have to stop thinking in totals and start thinking in flows. Global silver supply comes from three main sources: primary and byproduct mining, approximately 850 million ounces per year; recycling, roughly 200 million ounces per year, highly price sensitive; above ground inventories, exchange stocks, private vaults, and industrial buffers. On the demand side, the structure has changed dramatically over the past decade. Traditional uses, jewelry, silverware, photography, have either stagnated or declined. Industrial demand has surged. Solar alone now consumes an estimated 160 to 200 million ounces per year, up from under 100 million a decade ago. Add electronics, brazing alloys, medical uses, and automotive components, and industrial demand sits near 550 to 600 million ounces annually. Investment demand is the swing factor. In a low-stress year, it may be 150 to 200 million ounces. In a high-stress year, it can exceed 300 to 350 million. The result is that total demand frequently runs between 950 million and 1.1 billion ounces. That creates a structural gap. Even at the high end, 850 million mined plus 200 million recycled, you barely cover 1.05 billion ounces. In weaker recycling years, total supply may be closer to 950 million. The difference is bridged by inventory drawdowns. Now consider the location of those inventories. A large fraction of above-ground silver is in forms unsuitable for immediate industrial use: antique silverware, jewelry, small bars, and coins. Converting that into 1,000-ounce good delivery bars requires time, energy, and refining capacity. Exchange registered stocks, the metal that can settle futures, are only a thin slice of the total. Let's construct three simplified scenarios. Scenario A: normal flow mine, plus recycle, 1.0 billion ounces. Total demand, 1.0 billion ounces. Exchange stocks remain stable at 30 to 35 million ounces. Delivery requests stay under 2% of open interest. The system clears. Premiums remain modest, typically 0.50, 150 over spot for bars. Scenario B: mild stress mine, plus recycle, 980 million ounces. Total demand, 1.05 billion ounces. Inventory drawdown, 70 million ounces. Delivery requests rise to 4 to 5% of open interest. Exchange stocks fall from 35 million to 25 million ounces. Banks still fulfill orders, but lead times extend. Premiums rise to $2 to $4 over spot. Futures begin to show backwardation in nearby months. Scenario C: flow shock mine, plus recycle, 960 million ounces. Total demand, 1.1 billion ounces. Inventory drawdown, 140 million ounces. Delivery requests reach 6 to 8% during a risk event. Registered stocks fall below 20 million ounces. A single active COMEX month may see 30 to 40 million ounces standing for delivery. The math no longer balances in real time. This is where quiet suspensions appear, not because silver vanishes, but because conversion capacity becomes the bottleneck. Refiners cannot instantly double throughput. Air freight does not scale overnight. Vaulting capacity is fixed. What looks like abundance in annual statistics becomes scarcity in weekly operations. This is why normal expectations fail. Market participants assume that if global inventories are hundreds of millions of ounces, delivery must be trivial, but only a fraction of that metal is, in the right form, in the right location, under the right legal title, available within settlement windows, the futures market prices time, the physical market prices immediacy. When those two diverge, the price signal stops being smooth and starts becoming a rationing mechanism. When physical stress becomes visible in a commodity market, the reaction is rarely linear. It does not move cleanly from tight to scarce. Instead, it passes through a series of feedback loops that amplify small frictions into large price moves. The first signal is almost never a headline. It is a microstructure change. Bid-ask spreads in nearby futures widen from, say, 0.01 to 0.05. The front month contract begins trading $0.50, $1.50 above deferred months. Physical premiums in wholesale markets jump from $1 to $3, then to $5. Delivery notices cluster in a single expiration cycle instead of spreading evenly. To a casual observer, nothing looks broken. Prices still print, charts still move. But liquidity has thinned. Market makers become defensive. They quote less size. A trade that once moved 5,000 ounces now moves 500. This is where reflexivity begins. Industrial hedgers see higher nearby prices and step in to lock supply. That pushes the front month higher still. Shorts, seeing backwardation, face a cost to roll. Some cover. That lifts price. ETFs, tracking spot, register inflows. They source bars. That draws down inventories further. Each of these actions is rational in isolation. Together they form a loop. Tight supply, higher immediacy premium, hedging and covering, more physical demand, tighter supply. This is why commodity stress often looks like a sudden spike rather than a gradual trend. The system is designed to be smooth until it isn't. Once a threshold is crossed, behavior changes discontinuously. Another effect is correlation breakdown. In normal conditions, silver trades as a hybrid, part industrial metal, part monetary asset. It often correlates with gold, real yields, and the dollar. Under physical stress, those correlations weaken. Silver can rise even as real rates rise. It can outperform gold by 10 to 20% over weeks. Observers interpret this as speculation. In reality, it is flow-driven repricing. Volatility follows. Implied volatility in options expands. A 30-day at-the-money silver option might move from 25% to 40% implied. That raises hedging costs. Dealers adjust gamma exposure. Small price moves produce larger hedging flows. The market becomes jumpier. Liquidity in adjacent markets thins as well. Coin dealers raise premiums preemptively, mince ration sales. Retail buyers interpret this as shortage, increasing demand. That retail flow is small in tonnage but large in signaling. It reinforces the narrative of tightness. This is the paradox. The system reacts not to absolute scarcity, but to the risk of failed delivery. Markets are forward-looking. They price the possibility that the next marginal buyer may not be able to obtain metal on schedule. What should observers watch? The spread between the front and second futures month. Sustained backwardation above 0.75 is meaningful. Registered exchange inventories. A decline of 20-30% over a quarter is material. Wholesale bar premiums relative to spot. Delivery volume concentrated in a single month. ETF metal inflows exceeding 5 to 10 million ounces in a short period. None of these alone proves crisis. Together they describe a system moving from abundance to tightness. The reaction often appears irrational because it violates intuition. How can a market with 1 billion ounces of annual supply be stressed over a few million ounces? The answer is that time is the scarce resource. Futures compress years of production into daily liquidity. Physical markets cannot. When those two layers decouple, price stops being just a reflection of value and becomes a coordination tool, deciding who gets metal now and who waits. When a market transitions from ample to tight, the critical variable is not price, it is time. Stress does not announce itself with a single event. It unfolds across operational windows, settlement cycles, contract expiries, shipping schedules, production lead times. That gives us a natural timeline. Next 24-72 hours. The first changes appear in microstructure. Front-month futures spreads widen. Wholesale premiums update quietly. Dealers adjust delivery estimates from 3-5 days to 2-4 weeks. Nothing breaks. But friction becomes visible to participants who live inside the system. Next 1-2 weeks, if tightness persists, behavior changes. Hedgers accelerate forward buying. Funds reduce short exposure. Exchange inventories update with noticeable weekly declines. Perhaps 1-2 million ounces per report instead of flat readings. Social narratives begin forming, but the real signal is still in spreads and settlement terms. Next 1-3 months. This is where outcomes diverge. Either the system absorbs the shock through price and flow, or it enters a reflexive loop. We can frame 3 scenarios. 1. Base case, managed tightness. In this path, higher prices and premiums do their job. Spot silver rises 10 to 20% over several months. Recycling increases by 20-40 million ounces annually. Some investment demand is priced out. Delivery delays normalize as flows rebalance. The system bends but does not fracture. Banks keep extending windows, but fulfillment remains reliable. Industrial users pay higher costs but maintain supply. Confirming indicators: front-month backwardation stays under 0.75. Registered inventories stabilize above 25 million ounces. Premiums peak and then flatten. ETF inflows slow after initial bursts. This is the market functioning as designed, price as a pressure valve. 2. Stress case, flow break. Here, demand accelerates faster than supply response. Industrial demand remains inelastic. Investment inflows exceed 150-200 million ounces annualized. Delivery requests rise above 6% of open interest. Registered stocks fall below 20 million ounces. Banks respond with tighter terms. Minimum delivery sizes rise. Some products become cash settlement preferred. Front-month futures trade $153 above deferred months. Price may rise 30-50% in a compressed window, not because silver ran out, but because immediacy becomes scarce. Confirming indicators: sustained backwardation above 125, weekly inventory drops exceeding 2.3 million ounces, wholesale bar premiums above $5, concentrated delivery in a single contract month, exchange rule changes or specification adjustments. This is where credibility, not supply, becomes the constraint. 3. Relief case, external stabilization. In this outcome, an external factor eases pressure. A macro slowdown reduces industrial demand by 5 to 10%. The dollar strengthens, damping investment inflows. Large holders release inventory. Exchanges coordinate with vaults to expand deliverable categories. Tightness fades without major repricing. Delays reverse. The narrative dissipates. Confirming indicators: falling solar and electronics orders, rising real yields paired with declining ETF flows, inventory restocking, narrowing futures spreads. This scenario requires demand destruction or policy-level coordination. The key insight across all three paths is structural. Markets fail at the margin, not in totals. A billion-ounce annual system can be destabilized by a few million ounces in the wrong place at the wrong time. That is why normal expectations break. Participants assume abundance guarantees access, but modern commodity markets are optimized for netting and rolling, not for synchronized conversion from paper to metal. Delivery delays are not the end of a system. They are a message from its plumbing. They say, flow is tighter than you think. And in finance, flow is what determines who moves first, who pays more, and who waits. This content is provided for educational purposes only. It is not financial advice. Commodity and financial markets involve significant risk, including volatility, illiquidity, and the potential for loss. Always consult qualified professionals before making financial decisions.